Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending March 24th, 2023. I'm Preston Brent. Thanks for tuning in. This week's theme is hope versus experience. Let's kind of get into where we were this past week and what I see coming up over the next month or so. If we look at the markets for the week, you can see everybody's in the green. We still have a split index. We got both the Dow and the Russell in the red. NASDAQ up double digits, 12.97%, S&P up 3.42%, but the Dow and Russell still in the red for the week. Very choppy week. In fact, small cap stocks, along with the Dow, are underperforming so far. And if you take a look at the S&P Equal Weight, because if you look at Microsoft and Apple, that accounts for almost 14% of the S&P. But if you make every individual stock that makes up or comprises the S&P equally weighted, it is down 1.89% for the year. So we're clearly having a little bit of a rotation and outperformance by some of the FANG stocks. Okay. But you know, when you typically see what we've seen over the past few weeks, we get a dramatic shift in market performance and a lot of allocation. If you look at the PE ratio, we're still at a 17.75 go forward 12-month PE ratio. I still think that's too high by several points, which tells us that we can expect the markets to pull back. Possibly not in the next 3 to 4 weeks, but clearly as we get through the summer months, I could see the markets pulling back a little bit more. The dividend yield for the S&P is at 1.73%. 10-year Treasury coming in for the week at 3.38, so it's higher by 165 bips. Earnings yield is at 5.54 for the S&P. And you could see the S&P over the 10-year for the earnings yield is about 167 basis points. So that's still in the green, but the real yield is still a negative, just slightly under 0.5% with inflation around 6%. Current VIX fell this week 14.78% to close out the week at 21.74. And then you can see the weekly performance here on the screen. The best performer was communication services for the week, and it also took over technology by outperforming year to date as well, over 18.3%. Worst performer for the week, real estate, coming in at 1.29. Energy's bringing up the rear at 10.02. We did see weekly jobless claims this week remain at near 5-decade lows, and the S&P Global Composite Index of both manufacturing and services, it jumped from 50.1 up to 53.3. So we're still seeing underneath the bluster here a fairly strong economy, and with inflation coming in higher, we're seeing this is the fastest pace of growth in the private sector since last May. Okay, so still fairly strong, and that's going to keep inflation a little bit higher. Although with the problems that we're seeing in the banking sector, it is going to be a little bit disinflationary. So we got some cross currents going on there. The other thing, as we all expected, I had said last week we would get a hawkish, dovish Fed, which we did. We get a little bit of a hawk because they raised rates by 25 basis points to 4.75 to 5% range. The dot plot showed that they really expect one more rate hike, basically, maybe in May. Our next Fed meeting is in early May, so we should see that as another 25 basis points. But he did say that there's a lot of uncertainty in the forecast. Okay. The markets, however, believe that the Feds are going to start cutting rates at the end of this year. It's just a dramatic change from where we were before SVB, Silicon Valley Bank, crashed and burned a few weeks ago. We were forecasting a 50 basis point rate hike and rates up over 5.5%, has pulled back dramatically. Okay. Hang on just 1 second, guys. Although we've got a divergence starting to take place again, same as we saw in January. The bond market is seeing rate cuts in this year, although Boom Boom Powell, that would be Jerome Power Ranger Boom Boom Powell, at his press conference this past week, he said he does not see rate cuts happening this year. But then again, all it takes is just a couple of unintended consequences in the banking sector, and then Boom Boom Powell will be all over rate cuts. Um, so, in fact, the Fed Fund Futures is predicting over a 98% chance that we're going to start cutting rates and they're going to end up back a little bit lower than where they are right now. It's amazing how that's shaking itself out. Of course, if we go across the pond and look at Europe, you're going to see Europe. Everybody's in the green for the week. The Euro stocks, that's the 50 largest companies across Europe. The FTSE, CAC 40, DAX, all in the green. The only one in the red year to date across Europe is London Index, the FTSE, just barely. And then we did get out of the UK. Bank of England also raised their rates 25 basis points as well, to 4.25%. That's their 11th consecutive increase. They've been doing it, going relatively slow, but they've been raising the rate slowly, like I said, for quite some time. And then on a year-over-year basis, we did see inflation come in for the first time since last year, double digits at 10.4%. Really wild. And the Eurozone, meanwhile, we see business activity there expanding faster than expected in March, um, mostly driven by growth in the services sector. The S&P Global Eurozone Composite PMI came in at a 10-month high at 54.1 in March. So we're seeing some underlying strength. But we've got inflation there, and just what will the Feds do? And how will they react to inflation is really going to drive how this market's going to look. Although, if you look at the yield curve, not only here but over in Europe, it is forecasting a recession sometime later this year or early in 2024. Okay, so real be interesting. Now, of course, if you look at the Asian markets, you can see both China and Hang Seng in the green this past week as well as year to date. In Japan, their inflation slowed, all right, with core CPI coming in at 3.1% year over year, and that was down from 4.2% the prior month. So still a 4-decade high, but it is coming down. And Japan is one of the few countries that's still putting stimulus into the economy. And if we look at China, you can see over there as well, Chinese stocks were up a little bit because the People's Bank of China is still maintaining an accommodative stance there as well. So both China and Japan are putting money into their markets, respective markets. And the PBOC left their 1 and 5 year loan rates pretty much as they are, right? So they haven't really done anything there, but they're putting money into the economy. We're also seeing, because they came out of their zero COVID policy this past December. Remember, they've only been in for now for about 2.5 months. They came out of their zero COVID. It's going to take the consumers probably another 6 months to really feel more comfortable because they've been locked down for almost 2.5 or 3 years. But their economic indicators are picking up a little bit in consumption and infrastructure investment, right, after they're coming out of their lockdown. But again, they're maintaining an accommodative stance. So we can expect that for quite some time across China and in Japan. If I shift the screen now and just show you some of the key stocks and just kind of what I'm looking at here, we're going to look at the E-mini S&P 500 futures first. And you're going to see here that we really haven't gone anywhere. Coming all the way back over on the left-hand side of the screen since the middle of December, it's just up, down, up, down, up, down. We made a higher pivot low here on March 13th than we did back over here on December 22nd. But it's still very, very choppy, and we're kind of range bound. You can see 4,200, roughly 4,208 high point on February 2nd, low point 38.14 on January 3rd. So we've just kind of traded in this range for quite some time. Now, the only thing I think that's going to give us a lift and move us back up over here, you got to get a couple of things settled. The banking sector's got to settle down. There can't be any more risk to unintended consequences of bank failure. We're seeing credit default swaps pick up a little bit. We saw that in Deutsche Bank on Friday, rumors are circulating that credit default swaps are moving up a little bit higher in several other banking institutions, and that can cause action in the markets. And members, this Sunday evening, I'll go over what is a credit default swap and how does it work. But you can see here where we're sitting right now in the markets. Now, if I'm going to show you, I got a custom index, a FANG index, right? And on the FANG index, you can see we hit a high point on March 22nd, just 3 calendar days ago, of 30.74%. Now, this is the main thing that's driving the S&P up and keeping it over zero for the year. As I told you, the equal weight S&P is in the red for the year, right? It's in the red. So you can see where this is sitting here. It is really holding the markets up. Everybody else, there's like 495 companies that are pretty much flat for the year, and about 5 companies solidly in the green, essentially. And that would be the FANG stocks: Microsoft, Meta, Apple, Google, and Amazon, right? So it really shows a little bit of disparity here. But why are these stocks doing well when the FANG stocks last year performed so terrible? Well, the markets are making the bet over 90%, as I said earlier, that the rates are going to start coming down. That tends to be good for technology, but probably more so than that. A lot of money is going into Apple and Microsoft and some of these because they got a strong balance sheet and strong cash flow. And that is kind of where the markets are sitting. And they're looking for, money is looking for some bit of growth, yet some safety. And when you've got the type of environment that we have, strong cash flow means a lot. All right. Strong balance sheets mean a lot. And that's one of the reasons that's got money coming into these things. Okay. If we look at the Dow, one of the main indexes in the red, you can see here we're below the blue line, which is where we closed in 2022. We actually hit a low point on March 15th this month, being down intraday 4.85%. But we're chopping around down here. And the other one that hit a low point, if we look at the Russell, small cap, you can see here with small cap, we're down about 4.17%, near a fib node, but still in the red, okay? And then, of course, if we look at NASDAQ, it is doing really well. But if we look at NASDAQ 100 futures, let me just find this on the screen here. Here we go. NASDAQ 100 futures, it's going to be up very high. Look at this. It hit a high of 18.48% on March 22nd. NASDAQ 100 futures, of which the FANG index controls almost 44, 45% of NASDAQ, right? So when you're looking at NASDAQ futures, or you're looking at the S&P, particularly NASDAQ futures, it's driven by the FANGs. Now, if the FANGs pull back, right, if we get a pullback in those stocks, you're going to see the S&P drop just because of the weighting that they have. All right, really tough. If we come down here and look at volatility, volatility came down for the week, but you can see the intraday high in volatility this past week was you can see the intraday volatility and volatility, or the intra-week volatility, was always up here around 28, right? It was very, very high. So, but we look at the chop. I mean, it's just red bar, green bar, red bar, green bar, all the way around, right? Just really jamming right here. So we're getting a lot of chop, but that's kind of what I would expect in volatility with what we're trying to do and getting this banking sector all sorted out here. All right. So we're going to get that all figured out. If the banking sector calms down and we see credit default swaps start to come in a little bit, then I think we're going to get a little bit of a run in the markets. And if we come down here and we look at treasuries, look at the bond market. The bond market is up. The higher the bond market goes, the lower interest rates go. And we hit a high for this year in bonds on March 16th. Okay. So that was only about 10 calendar days ago, 9 calendar days ago. Bonds were up, obviously interest rates down. You could see this big move down here. And if we look at the 10-year rate, you can see here the 10-year rate has broached the 50 and the 200 SMA. And we actually took out the prior pivot low. This would all suggest the 10-year is now down at 3.33, right? And I don't need to remind you that the 10-year rate was up at 4.33 back over here on where was that? That was back here on in October, right? So just a lot of chop. Look at the interest rates, and this is what's driven the regional banks really crazy. Okay, with the big move lower in rates, move higher in bonds. That's caused some action in the regional bank sector. Members, we'll go through a little bit more of this in detail here and ways that you can play it. And then, of course, if we come over here and look at currencies, the euro, longer term, I think is going to be bullish. You can see here my target for the euro is up around $1.11, and it's back in the green again for the year. The dollar, longer term, I'm short, although it had a strong Friday, but I think this is going to come down and make new lows in 2023. Okay. And then, of course, if we look at gold, the banking sector has helped move gold higher. You can see here gold was up 10.01% on March 20th, well north here, but we're trading within these wider bands right here. You can see where gold is sitting right here on this band. And then the 2022 high was 2078. Now, long term, I've been bullish gold, but that carries us out to 24.25. Short term, there's going to be a lot of chop. But right now, I wouldn't chase it up at this level. A little bit of a pullback, but any kind of dip on gold, I would be an interested buyer. Okay. And then, of course, if we come down and look at energy, well, energy is, I like it down at this level because I think it's more of a buy than a sell, right? You can see we hit lows here on March 20th, down 20.35%. And it really hasn't done anything this year. It's kind of rolled over, but I think we're getting down to a point where, and we have ways to trade oil for our members that make a lot of sense and can do fairly well. And down at these levels, you just have to take the trade, right? Based on what we do. Nat gas, we've already shorted that. We're out of the market, but it's just been a great past 6 to 8 months for nat gas. Just wonderful shorting opportunities playing nat gas with the problems that they've got going on in Europe. All right, everybody, this is just a really short summary of where we are. Members, I will see you this Sunday evening. Got a lot to talk about. We'll look at volatility a little bit more closely, some stocks that look pretty good. I'll go over the credit default swaps, talk a little bit about how that works. And it's a good canary in a coal mine kind of thing. Remember, we want to follow the bond and the credit market and spreads very closely, even if you don't trade it, because it tells us where the equity markets are going to want to go out in time. All right, everybody, have a great weekend. And members, I'll see you Sunday evening. Ciao.